Assalamualaikum and hello everyone. Welcome to Principal Malaysia's 2024 Quarter 1 Market Outlook. I'm Fartini, a moderator for the session today. I'm delighted to introduce our speakers. We have Mr. Lee Chun Hong, Head of Equities of Principal Malaysia, and we have Mr. Jesse Liu, Chief Investment Officer of Fixed Income of Principal Southeast Asia. And with that, let's start our conversation. How are you, Chun Hong?
I'm good, thanks, Fatini.
All right. As we look at 2023 briefly, is it clear that the global equity markets have shown many interesting trends? Despite challenges, the developed market performed strongly, while the Asia market was more subdued. Overall, though countries like Taiwan, Korea, India, they stood out as winners. So can you give us your thoughts on this situation, particularly when comparing developed markets versus Asia-Pac ex-Japan equities?
Oh, thanks, Fatini. Thanks for the question. So who would have thought that 2021, after 2021 and 2022, bad year, Malaysia ex-Japan continue to see a tough year in 2023. But if you break out the region into country, yes, like you pointed out, Thailand, Korea, India outperformed and generated a positive return so far in 2023. But the first two, like Taiwan and Korea, mainly are all tech name. As you know that in 2022, they have a very bad year. So from a low base, it's not surprising for them to see a better year in 2023. And also the peaking of interest rate and also the bottoming of the semiconductor in the second half of 2023 also further propel the market along with the US tech. But the standout one will be India. India is the only country among these three to register all-time high in terms of the performance. Why so? First of all, the domestic growth continues to be quite strong. And then they've got a very healthy domestic mutual fund, continue to grow at a healthy rate. And also a strong government under Modi, so it's been attracting a lot of FDI. And also the company continue to grow. So with that, I mean, not surprising to see India outperformance. So that India is a very standout compared to the other two. Whereas the Asia Pac, I mean, Japan, China is key. So we need to watch China very closely. So in 2023, it started well. So it popped in the first 2 months and subsequently entered the bear market. And this bear market is one of the longest in the history, more than 900 days of bear market. So this is very surprising. So positioning and also expectation is very low right now at the moment for China market. But we require a very strong, drastic fiscal stimulus or approach to attract the fund flow back or to attract the interest of foreign investors to come back. Yeah.
Okay, thank you so much for your perspective. Now, the next question, Chun Hong. Given what you just highlighted, that developed markets outperformed Asia, do you anticipate this trend to continue in 2024, considering the potential adjustment to money policy and potential change in economic cycle? And do you believe the current strong momentum in growth assets, whether it's AI or technology theme, will continue in 2024?
Okay, thanks. So we reckon that in the developed market, we have to be more selective. So right now, at the moment, we are only positive on Japan. And because the regulator in Japan are forcing all the company listed on the stock exchange to generate better or improve the profitability and also increase the dividend payout. So which is good for the investor. So everyone are plowing the money into the Japanese market. At the same time, Japanese, as you know, they have a very good company. It's trading at a very attractive valuation compared to US and Europe. So we are a bit underweight on the US and Euro market because of elevated valuation. And also the restrictive monetary policy in these two part of the world will start to eat into the consumption eventually. So we are negative these two nations. And also in particular in Europe, some of the countries within Europe are entering recession or in recession, but yet the market is trading at a multi-year high. So yeah, so in 2024, we are slightly more constructive and positive on Asia Pac ex-Japan. We think that that's the interesting investment team, and also there's a potential for the corporate in Asia to generate a better return compared to the developed market in 2024. So we are positive on the Asia as Japan. But on the theme of growth or AI or tech team, we think the trend is here to stay because it's a multi-year play for this team. And most of this team, the company within this team have very strong balance sheet and bargaining power. But be mindful, we are cognizant that this team are priced to perfection at the moment. So there could be some profit taking in the coming months. That could be a very interesting opportunity for the fund manager to buy back. Yeah.
Okay. Thank you, Chun Hong. Now, Jesse, what are your thoughts on future policy rates globally and in Malaysia in 2024? Do you foresee any potential impacts on fixed income assets?
Right, thanks for the question, Tini. And good day to you. So if we look into more developed markets like the US, I think they have been on a high policy rate environment for quite some time, and they are really very restrictive at this point in time. So if we are talking about the neutral rate in the US, they are probably, the estimate is closer to 1% thereabouts, or about 2%. The long-term expectation of Fed funds rate is actually closer to 2.5%, but right now we are looking at Fed funds rate at about 5.25 to 5.5%. So that environment is actually very restrictive by historical standards, and it has resulted in several economic indicators coming in or trending lower. For example, inflation is going lower, although lately we have seen unemployment numbers be relatively a little bit more resilient, but still it is trending a little lower than what we are seeing in the past few months. So in that sense, I do feel that if economic conditions continue to move in that direction, it would drive policymakers to reconsider how tight they would really want their policy rates to be. And I won't be surprised if there's going to be some adjustments to it. What's key right now for the US is that if I were to look at policy rates, I would say that we are thinking about 2 cuts thereabouts in 2024, but markets is actually pricing in about 4 to 5 cuts. So in that sense, I think there are some divergence between what we think economic indication is actually saying, versus where market is really pricing it. So in that sense, I think for US, it is still a big wild card for policy rates as compared to other parts of the world. So like what Chun Hong mentioned, if we look into the Euro area, it's probably easier for you to guess, largely because you are seeing a slowdown that's coming into Euro area. So probably policy rates would be much easier to forecast in that sense, bearing in mind that the only caveat is how inflation will play out in that region. For ASEAN or Asia, it's a lot more stable, as we can see this year. So if we compare to US swing from from gains to losses to gains for their bond market. But if you look at Asia, if you are invested in a market where our policy rate has been stable, returns would be relatively stable. So an idea would be in Malaysia, our policy rate has been really predictable in that sense, and returns have been equally as predictable. So I would say moving forward, 2024, if Malaysia continues to be predictable where it is, we expect interest rate to be where it is today, then it should not be any different in terms of returns. It should be predictable back into where historicals are, probably about the 5% range thereabout.
Okay. So we're going to go back to Chun Hong. Chun Hong, now give us an update on the current sentiment in the Malaysian market. Are we seeing increased foreign investment, especially after the recent announcements of the new energy transition roadmap and a new industrial master plan 2030?
Okay, thanks. Yeah, so for Malaysia, just to recap, so earlier on that we guided the investor that post second quarter of 2023, you see a slowdown in terms of GDP numbers, largely because remember that we only reopened the economy in April 2022. So the high base is one reason. And secondly, that this year onwards, all the festivals like Chinese New Year, Hari Raya, back to school in March, everything happened in the first quarter. So all the spending will be done in the first quarter. And after that, there will be some overhang in terms of spending and people start to save on the front. So that is why we reckon that the GDP number has been revised down by the economists since the beginning of the year. And we reckon that potentially would grow slower than 4% as what market is saying right now, or the consensus is expecting right now. So what's next? So investment has been plowing, but of course the fund flow had came in July up until now, November. But right now, market are just waiting patiently on the detail being shared by the government. So after a series of announcements, like one rightly mentioned, first Madani economy, and then the new energy transition roadmap, and then followed by new industrial master plan. These are all big picture announcements. But what the investor want is more details. But whether the investor have the patience to wait for it, but or not, I have to honestly say the patience is running low because of a series of delay in terms of announcement. So the government need to back up and start to share and more communication with the investor, to the market, and more details of how they want to carry it out, and of course, red tape. Okay, so that's what is what the investor at the moment wanting at the moment. So to move the market further, this is what the government need to do. Okay, so but interestingly to share, in December, NVIDIA founder Jason Huang was in Malaysia and also in this region. So he has announced that they would work together with one of the corporate in Malaysia, YTL, and the total investment is up to 20 billion as shared by our Prime Minister, Dato Sri Anwar. So that is positive, but we need more of this. But to move the market further, the government need to deliver and execute what they say. Because we have lost last 5 years, and we cannot lose again. So if not, all the FDI will just flow to our neighbor instead of Malaysia.
Okay, thank you. Jessie, we're going to switch gear a little bit, right? So how do you view the geopolitical events in different parts of the world impacting the current investment environment?
So in terms of these impacts of geopolitical to asset prices, it has been quite different. If we look into the Russia-Ukraine war, the impact was more towards commodities. For example, we saw changes in commodity prices like grains, like energy prices. So those were more visible and more impactful, especially when during the onstart of the conflict. But when we look at, for example, the Hamas-Israel war that's happening right now, the impact was felt in the oil market somewhat, but that reversed quite quickly after that. So I would say that these two conflicts, these geopolitical conflicts right now, they have their difference, largely because in the countries that's involved, like Ukraine and Russia, they are actually supplier of those commodities. And they are major suppliers to the global markets. But if you look into Hamas and Israel, they are not actually big contributors in that sense. So I would say that's why you see that difference in impact on asset prices or commodity prices for the difference of those impact between those two conflicts. Now, where we think it's going to be heading forward, of course, if the conflict within those countries which they supply a lot of those products escalates, we do think that there's going to be more impact on commodity prices. So if I were to put the risk, I would say that Ukraine and Russia probably carries a little bit more risk as compared to the Hamas-Israel war, largely because they are involved in that supply chain of commodities.
Okay, thank you so much for your perspective. Now, we're going to move on to Asia-Pacific region. As we approach 2024, there's a lot of anticipation that Asia may finally see a rebound based on the recent forecast of future earnings. However, China's overall outlook still suggests that the recovery might be inconsistent, even with the recent government support. Chun Hong, what's your insights on this situation, and how do you see Asia-Pacific in 2024?
So yes, right. China is key, as mentioned earlier, is the largest component of the major Asia ex-Japan indexes. So at the moment, the China policy has turned more supportive, but yet too early to tell whether it will revive back the animal spirit in the country itself. Of course, as mentioned earlier, the consumer confidence and also private sector confidence are very low after the COVID and also the property downturn that hurting some of the consumer there. So yes, it's supportive, but too early to tell. So in terms of stock selection, we are very discerning. So we are very careful in terms of what we put the money in China. But at the moment, the portfolio construction are mainly centered around the theme of bottoming of tech hardware stocks and also improving sentiment in India. So that's where the portfolio is skewed towards at the moment. Yeah.
Thank you, Chun Hong. Now, I would also appreciate hearing your viewpoint on Southeast Asia. So, based on the latest market forecast, it appears that there could be adjustment to the monetary policy in developed market in second half of 2024. Are we anticipating any reversal in US dollars? Can any of the development affect the performance of the market?
Okay, So the performance of the equity market in ASEAN in particular, so it depends a lot on the direction of the dollar. So how the dollar will behave going to 2024, we reckon it has peaked, as shared by Jesse, that the interest rate trajectory is on the way down. So generally, then there's rest room for dollar to appreciate from here. So that gives some breathing room to ASEAN equity and also the emerging market. But how are we structured in terms of the portfolio? So we generally are positive, bullish in the fourth quarter, entering into first quarter of 2024. We are positive, but subsequently we turn neutral, largely because, as you know, that Indonesia, one of the favorite amongst the investors, beside Vietnam, are having their 5th presidential election on the 14th of February. So generally when we come to election, investor, whether it's capital market or FDI, they generally will just hold back and have a look and see who's the new government coming in or new president. So the moment the market is pricing in a 2 election, which reason why, because they don't think there will be a clear winner in the first run. So we need to be more cautious until we see a clear winner. But if the country managed to announce a new president on the first run, there will be a bonus for Indonesia. But till then, we are cautious until we get a result of the presidential election. But nothing is lost. So as mentioned, that ASEAN is a trade nation. So we have been on the drought for the past 12 months. So we reckon the export will pick up, as what we expect the quantum being a semicon tech sector. So Malaysia, in particular, together with Thailand and Vietnam, are heavy in terms of the manufacturing of this product. So we will see a recovery, slow recovery as we enter 2024. So that could be positive on the equity market for this region. And then subsequently, like I mentioned by Jesse, we are expecting a rate cut in 2024 towards the second half of the year. So we will turn positive when that time arrives. Because with the declining interest rate and also softening of US dollar, it should be positive for ASEAN. Yep. So so we are turning more positive in the second half. And also, like, what if the rate cut happens? Asia central banker has more room to cut faster because we don't suffer the inflationary issue that what's been suffered by Euro or even US. So that could be very positive for equity market in the second half.
That's good news for Malaysia. And as we wrap up today's discussion, let's get some advice for our investors regarding the asset allocation for 2024. So Chun Hon, let's begin with you, and then we'll hear from Jesse.
Okay, so let's share what has transpired so far in 2021, 2022, 2023. So the bond yield has risen in certain market, and we think that is attractive. At the same time, also the equity market has underperformed the developed market for a couple of years, and we shared that in 2024, some of the corporate in Asia with an interesting investment team could grow much faster than developed market. So that's with a decent valuation. We think that there's an equal chance for equity and fixed income to perform in 2024. So at the moment, we are positive on both sides. And also, we have tilted our portfolio towards income-focused companies. So in time of volatility, company with the income will perform better and perform within the range during the volatility time. Then on the other side would be the growth side. As mentioned, some of the company would start to show some growth, and generally equity-like growth names. And those names with a balance sheet or strong balance sheet will outperform the index. So we are balancing both income and growth at the moment in the way that we structure the balance fund. So in terms of the product that we promoting at the moment is the way ASEAN, as mentioned. They're supported by dividend yield, and also growth. We will propose going through some of the small cap names or small cap funds that we have. We track the performance for the past 5 years. Small cap continue to generate a positive returns. And so we like fixed income. I would let Jesse talk more on the fixed income side.
Thanks. Thank you so much, Chun Hong.
So if I can add a little bit from where Chun Hong left off, I think as we are in a high interest rate environment, typically you are in an environment whereby companies, the government is trying to manufacture a slowdown in the economy. And with a slowdown, you tend to have much weaker fundamentals, especially broadly to a lot of companies. Borrowing costs are higher, refinancing will be more difficult. So in a sense, if you look at a broad environment like this, chances are you would want to be cognizant of the risk that will come if you increase the risk, your risk in your portfolio more towards asset classes whereby you're going to be susceptible to this high interest rate environment. So where fixed income really is helpful is when you are in a high interest rate environment, you are buying into investing into a particular product where the yield is already high. So I would say that on an asset allocation basis for fixed income, what we can do is that we want to be positioned into stable, more solid companies compared to the high yield ones. For our broad Asia portfolios, if we're looking into Malaysia, it makes a lot of sense for us to really buy into the AAA names, so as to protect our credit profile of the portfolios that we manage. If a slowdown does happen, if a hard landing does happen, chances are then you would see monetary policy would start to decline probably even faster than what we are anticipating. So in that sense, that would give another round of appreciation to bond prices, because as bond yields go down, prices go up faster. So in that sense, I think to continue from where Chun Hong says, I think it is very important that to have a very strong fixed income portfolio, even in the year that is coming, not only to protect oneself from the credit risk that can happen in 2024, but also there are opportunities if, let's say, the rate cut does happen more than what we anticipated. Investors would then benefit more in a bond market kind of an asset class or safe asset class compared to the riskier ones.
Okay.
Yeah.
So on that note, gentlemen, I'd like to thank you, Jesse, Chun Hong, for your invaluable perspectives today.
Thank you.
Thank you.
Thank you.
And to everyone watching, we hope that this market outlook has provided you some valuable insights and information to help you manage your long-term goals. Thank you everyone for watching. Till next time, stay safe and be well.